Making Options Trading a Little Bit More Fair by www.options-trading-educations.com. A new rule by the Options Clearing Corporation will be making options trading a little bit more fair. It will also take away a source of easy income from many options dealers. A recent article in Reuters talks about a soon-to-be-gone options trading strategy around dividends. Large market makers have long used a dividend-linked options trading strategy to make easy money by taking advantage of a hole in the Options Clearing Corporation's rules on clearing trades. New rules set to take effect later this month will close that loophole. Investors who own call options that are in the money, when the option strike price is below the price of the shares, can turn those options into shares just before the quarterly ex-dividend date for dividend-paying names. The ex-dividend date is the day on which an investor must own shares in order to collect that quarter's dividend. Many investors don't do this, however, for various reasons. That's where dealers step in, by buying and selling a large number of call options of the same stock at the same strike price on the day prior to the stock's ex-dividend date. The way this has worked is that the Options Clearing Corporation has cleared trades in which the call owner gets to exercise his right to buy shares before clearing call options that have been sold. By reversing the process, it will take away the opportunity for holding an option very short term for just the healthy dividend. Options, dividends, and arithmetic. For most of us, not dealers, we need to calculate the value of the dividend as part of the value of the option. We noted this a year ago in our article, Options, Dividends, and Volatility. We referred to a very useful article in Forbes about calculating the value of stock options on Cisco. Consistently, one of the more popular stocks people enter into their stock options watch list is stock options channel is Cisco Systems, CSCO, minus 0.67%, NASD, CSCO. So this week we highlight one interesting put contract and one interesting call contract from the April 2014 expiration for CSCO. The put contract our yield boost algorithm identified as particularly interesting is at the $20 strike, which has a bid at the time of this writing of 39 cents. Collecting that bid as the premium represents a 1.9% return against the $20 commitment, or a 4.5% annualized rate of return. At Stock Options Channel, we call this the yield boost. The point of this being that options trading can be reduced to arithmetic, providing that the playing field is level. The Options Clearinghouse, making options trading a little more fair, will help do this. Options and the negative skew. Making options trading a little more fair does not mean making it less profitable. As noted in the Forbes article, one can do the arithmetic and come home with a profit. There are also ways to improve the odds in trades that are otherwise less clear. This is brought up in an interesting article in Fox Business, which talks about options trading and its higher moments. One option pricing phenomenon is what the industry calls negative skew, and is most common in equity options. Skew is the contour or the unevenness in a distribution, the dent in the bell curve. A negative skew suggests the left half of the normal distribution, the left side of the mean, is twisted in such a way the prospect of achieving negative returns is superior to that of achieving large positive returns. The point of this discussion is that the probability of making money is higher on the side of the curve than the other. Add this to what you know about fundamentals, dividends, and the options market, and it enhances your opportunity for profit. For more useful information and insight into trading options, visit www.options-trading-education.com.